Short selling is a trading strategy in which an investor borrows shares of a stock from a brokerage firm and sells them on the open market, with the intention of buying back the shares at a later time to return them to the lender. The goal of short selling is to profit from a decline in the price of stock. Here's a step-by-step breakdown of how short selling works. 1. The investor borrows shares of a stock from a brokerage. These borrowed shares are typically sold immediately in the market. 2. If the stock's price falls, the investor can buy back the shares at the lower price. They return the borrowed shares to the brokerage and keep the difference between the selling price and the buying price as profit, minus any fees and costs. 3. However, if the stock's price rises, the investor faces potential losses. They would need to buy back the shares at the higher price to return them to the brokerage, resulting in a loss. Advantages of short selling. 1. Profit from declining prices. Short selling allows traders to profit from stocks that they believe are overvalued or have poor fundamentals. This can be especially useful during market downturns or for stocks showing signs of weakness. 2. Hedging. Short selling can act as a hedge against a long portfolio. If an investor holds a significant number of long positions, stocks they own and expect to rise, short positions can offset potential losses in case the market declines. 3. Expanded trading opportunities. Short selling enables traders to benefit from both upward and downward price movements, providing additional trading opportunities. Disadvantages of short selling. 1. Unlimited losses. Unlike buying a stock, where the maximum loss is the initial investment, short selling can lead to unlimited losses. If the stock price rises significantly, the losses can accumulate rapidly. 2. Borrowing costs. Borrowing shares to sell them short involves borrowing fees and sometimes interest payments. These costs can eat into potential profits or increase losses. 3. Timing risks. Timing is critical in short selling. If the investor shorts a stock that increases in price, they could face losses and the need to buy back shares at a higher price. 4. Regulatory constraints. Short selling is subject to regulations that may restrict or temporarily ban the practice, especially during periods of high market volatility. 5. Market manipulation concerns. Short selling can be used to manipulate stock prices through the spread of negative rumors or misinformation. This can raise ethical concerns and may be subject to regulatory scrutiny. 6. Emotional challenges. Short selling involves betting against companies, which can be emotionally challenging for some investors. It requires a different mindset than traditional long investing. Short selling is a sophisticated trading strategy that comes with higher risks compared to buying and holding stocks. Traders interested in short selling should have a strong understanding of market dynamics, a comprehensive risk management plan, and the ability to conduct thorough research and analysis. It's important to be aware of the potential for significant losses and to exercise caution when engaging in short selling activities. Created by Sasanka De Silva for the King's Exploits channel. Thanks for watching.